the overall averages really don't tell the whole story for what we've seen, with some individual names in sectors of the marketplace, Mike. And I guess you probably have felt like you're on the right track with your recent stance over the past 6 months or so, because we've seen it reflected in a lot of the former high flyers' favorite names. They're down a lot, some of them.
No, that's exactly right, Joe. I mean, I think that, for the last 6 months, being somewhat more conservative in your positioning has really played out. I mean, as you know, investing is not just about the index, it's about trying to beat the index. And the way you beat the index is you go to the parts of the market that are outperforming and avoiding, really, quite frankly, the ones that have really, underperformed. And as you mentioned, I mean, my goodness, it has been a raging bear market for high multiple stocks. And for anything speculative in nature, I mean, it's just been taken out to the woodshed. So there's probably some value to be, being created there now. I mean, it's been a bear market. We're in a bear market for like the average stock, and yet the index continues to hold on. So, good for the folks who are passive investing. They've done really well. Our model portfolio has done really well by being a bit more conservatively oriented, and that's right. That's why we're sticking to that. So what's going to change that view, I think, is two things. Number one, I mean, I think the Fed and central bank pricing is now in the market for sure, but they haven't even begun tightening yet, Joe. I mean, we've done a lot of price damage, but they're still adding accommodation to markets. Financial conditions remain as accommodative as we've ever seen, so they've got to get those financial conditions tighter, and that's going to continue to weigh on multiples. We think to the tune of about 10% the S&P level makes a lot of sense, maybe a little bit more if we have an overshoot. And then the second thing, which you're really focusing on today's note, is this idea that growth is going to potentially disappoint in the first half of this year because of the payback in demand, the consumer being a little bit on their heels because of inflation, and the fact that supply now is probably picking up at the wrong time. The combination of all three of those is going to lead to probably some under-earning, if you will. So even if the economy is okay, we're going to see more disappointments like we've seen here recently in some of the earnings numbers.
But the Fed will continue apace even with the disappointment in certain growth metrics?
Well, yeah, because it's not an economic problem. I mean, as you know, the jobs numbers are outstanding. I mean, we're still going to be growing the first half of this year. This is really the separation of, the economy is not the markets and the markets are not the economy, right? So as we've said all along, ending QE and raising rates shouldn't kill the economy, but it's going to be not great for financial markets. And that's just where we are in the evolution of this recovery. So, but not the end of the world.
Yeah, the bad news won't be good news for. So you're not a raging bear. You're not a Jeremy Grantham 45% pullback. You said, 4,400 best case scenario, but that's best case. So it could be quite a bit more than that. I'll just in defense of that viewpoint. You don't usually make a bottom when you're still calling something a stealth bear market. I mean, normally you have everybody talking about it and everybody, feeling the pain, blood on the street. So if you have to look hard at individual names and, sort of delve into the internals, if you will, of the averages, if you need to do that to find the bear market, you haven't hit a bottom yet.
I think that's right. I mean, well, at least for the index, right? I think obviously there are many sectors that are in a bear market. I mean, parts of healthcare, parts of technology, parts of consumer, I mean, clearly are in a bad spot right now. Look, I would say what you need to be doing right now as an investor is looking for areas that have already corrected or areas where there's probably pent-up demand. And we think two areas there are consumer services, as we make that transition from goods to services, and also healthcare and parts of technology too, where they've already corrected. I think that makes a lot of sense. And that's what we're trying to do. It is the year of the stock picker. It's not about the index anymore. And it's, we're going to get through this. It's not, this isn't the end of the world.